Folks, sometimes in life you need to have what I call adult conversations. These adult conversations are never fun, but must be had. And we are going to share with you an email that Jonathan Twomley sent out to his list that I read and reread and said, Jonathan, we have to talk about this. The net of it is bank failures, what you are not being told. Jonathan, let us have the adult conversation.
Yeah, well, listen, I love adult conversations. I don't know what it is. It's like that old, that Puritan ancestry of mine that where they something has come down through the generations where it's like, let's have this hard conversation. Life is tough, right? So but I have to say, so there's good news in my email, actually.
Absolutely. I loved how you did it, right? You said, this is the adult conversation. This is the hard part. This is the reality. And then you close with kind of 20%. It might be time to do the work. Get excited. There will be deals here, but let's do the first part first. Cause I don't think a lot of people are truly understanding what's going on. There's a lot of fear. And when there's fear, there's no focus. Like they're all over the place.
So what we have seen over the last week, I mean, literally, we went to bed on Friday last week or let's put it in the context of this podcast. When we put this podcast to rest last week, all was right with the world, right? I mean, we were fighting inflation. The Fed was raising rates.
BlackRock was talking about a terminal rate of 6% last Thursday morning.
Maybe
right?
Not everybody thought this was great news, but anyway, you and I thought we're getting back to it's going to a more stable basis for investing. And then, lo and behold, on Friday, SVB, the Silicon Valley Bank, which is the banker to Silicon Valley, as the name suggests, imploded, right? And what we immediately saw after that was, if you're basically subscribed to anybody's email list in the world, you immediately started getting emails about, don't worry, we're okay because we don't bank at Silicon Valley Bank, or we do bank at Silicon Valley Bank, but don't worry because the FDIC is going to step in and we'll be okay. And there was just this immediate idea that you had to go and reassure everybody that things were fine with you personally because of you did or you didn't have a relationship with Silicon Valley Bank. And that's just sort of exposed the fear that was out there, where this fear of contagion, right? And fear that everybody was going to be taken down by this. And let's say that the fear is not unreasonable, right? I mean, we've seen how bank panics get started. There's a huge psychological element to this. And, you did see some pushback too, if you were reading the press about hey, everybody, let's not go down this route of panic and create a crisis, right? Which is a lot, it's easier said than done, because if everybody's thinking for themselves, that's what a bank run is, right? Everybody's is worried. They're trying to get their money out before the next guy. They don't want to show up at the window and be told your money's not here, right?
Yeah, it's really I think people call it the prisoner's dilemma, right? There's no downside to take it out and move it. You can always move it back, but you don't want to be the last guy or the first guy where there's nothing left. So
it's also reasonable. Worse for everybody, right? That's the dilemma, the prisoner's dilemma, right? So that if both people act in their own self-interest, they actually get a worse deal than if they just keep their mouth shut, right? And then they both get a better deal, but they can't know, right? So they can't know what the other guy's doing, so they act rationally to try to save their own skin, but they wind up, getting a worse deal for both of them, right? So this is what I said, this is in Silicon Valley. Because of this, here are the things that are really going to happen. Yes, maybe the people that you're invested with or that I'm invested with don't really have any direct exposure to Silicon Valley Bank. But the general feeling of panic that this collapse, created, and unfortunately, I think some of this is beginning to subside a little bit now as people dig deeper into the facts and kind of the unique circumstances of Silicon Valley Bank. But nevertheless, it has created a lot of fear, which means that banks, as a general proposition, are going to get a little bit more wary about lending, right? They're going to, even if they have no exposure to this, even if they're not lending to startups, even if they're not involved in tech, there is just going to be some guy at the credit committee who's approving your loan who's going to be like, do we really want to do this loan? Is this a good time? Should maybe we hold back more dry powder? We don't know what's going to happen, blah, 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 blah. And then there is a kind of chain reaction that happens as a result of that, which is it's going to be harder to finance real estate deals. It's going to be harder to refinance real estate deals. And that's actually where the real danger is, that we've already been talking about how it is difficult for people who bought at the top and over leveraged as, in order to get the deals at the top. However, you can, whatever form, may not be bank leverage, right? But they're doing pref equity, they're doing interest only. They're all these kinds of devices that are not, simply just putting more debt on the property, but kind of doing the same thing at the end of the day. All of these, all of those people were already going to have a hard time refinancing because of the rise in interest rates. Now they're going to have even a harder time because banks are going to be more critical about the stuff that they're lending on. And they're going to be looking at this with a jaundiced eye, and they're going to be saying, we don't know about this, right? So that just made it tougher for everybody. But
so it's not, so let's go, before we go to the rosy side of this, because that's where we'll spend most of our time. I want to be clear, there's a couple of things. So first and foremost, again, this is an article I had on CNBC. Regional banks make up 50%, or at least they did last year, 50% of loan volume in commercial banks or commercial lending. That's a problem when regional banks are crumbling. To your point, the credit officers, there's going to be lots of credit officers and bank presidents saying, thou shalt not touch that. We are over-indexed. We are too focused, too concentrated, whatever the vocabulary is. So you can look to loan volume coming down. Second, you are going to look for them to use every avenue they have to force refis or cash outs or whatever, because they want less on their books, is my belief. And then I think the subtle point in your letter that I want to hit here even harder is limited partners, because I think all lenders will get a little bit more nervous and conservative, which will mean, buy better deals. They're going to want a higher return. The risk-free rate of return is 4 or 5%. It's just all types of harder. And I think where this really goes is the people who are conservative, who frankly weren't in the market the last 18 months because they thought it was a casino, they're going to benefit because they have receipts. Like, no, maybe I sold early, but damn it, I didn't see a pandemic coming. But now I'm ready. I've been doing the work, and now I'm putting deals together. So I think people are going to be over-indexed to the people that weren't in the market, because there's a lot of new players, and we've been highlighting it for at least a year, that are just going to get hurt. They were able to attract money because money was free, and now they overpaid, bridge debt, IOs. And there's, again, I've said it and I'll say it again, there's a lot of LPs that have lost their money and they don't even know it yet. So that's kind of the downside of the,
and when they find out, absolutely. And when those LPs find out what the situation is, they're going to be very reluctant to invest.
Some of them will never come back.
Some of them will never come back. They're once burned, right? I mean, why shy? So they're going, that is going to put a further dent into liquidity in the market, and it's going to cause cap rates to rise,
even more. Even further. I mean, we talked, go back on your playlist. Jonathan has an amazing playlist with hundreds of videos. You can go back and check videos from months ago. We've been talking about this. I think again, it's all risk, or really it's fear. I think what Saturday caused was fear. The other thing besides lending going down, Jonathan, I don't know if you agree with this or not, but I think consumer psychology was dented and damaged. And we may have started, the dreaded recession, because I think consumers, if they were going to spend on something, they're like, you know what, honey, we may need to use some dry powder, to use your term from earlier. I think there's a lot less consumption going on this week than last week, is my guess.
Yeah, I mean, it'll be interesting to see how this plays out, right? Because, I'm sure you saw the jobs report that came out this morning. 192,
under 200.
It's hot as ever, right? And so this may take some time, if it does happen, to kind of work its way through the system.
Yeah.
So we'll see. I mean, I think it's going to be important, how this sort of plays through, because as I mentioned a moment ago, the counter narrative has started where, people are talking about the unique things that Silicon Valley Bank did wrong. Including, you know, insiders betting against their own stock and just all kinds of insane stuff like that. And Peter Thiel coming out and like telling people to, like, you know, encouraging a bank run. And listen, the SEC is going to start opening some investigations into this. Apparently they always open investigations whenever there's a bank collapse, but I think there's some funny business that happened here for sure, where people were selling stock based on like either insider knowledge they had or stuff they were telling the market, right?
Yeah.
So
we'll see. This will be political theater. I'm worried about the deals and where people can make you know, life-changing, you know, investments, and that's where I want to go next.
Yeah. So, but you have to understand that when there's panic and fear in the markets, this is when the real money is made. Right.
Yeah, but back to the opening, right? Bank failures, what you're not being told. So again, we had 2 bank failures, Signature Bank and SVB. There's been a lot of talk about other regionals. First, what's it called? First Regional Bank? First
Republic.
First Republic Bank. Thank you. I believe, and I said this on Monday, I believe, there may not be more bank failures, meaning FDIC takes them over, but there's going to be some shotgun marriages.
Yeah.
And I think they're the first one to go. First Republic, they're going to be married. It looks like, I think it was JP Morgan and the Fed gave him money on Monday. It would not shock me. And again, this is Thursday, so I'm saying this with 24 hours to go, that First Republic is bought by JP Morgan by the end of the weekend.
I mean, listen, here's another thing that happened, which I don't know if you noticed this or not, but you know, Moody's came out this past week and, like, you know, lowered its ratings of all these banks, you know, which also sort of, I mean, I don't, you know, you
like what they did in the Great Recession, they lowered after.
Exactly. Now, maybe some of the younger folks or people who just weren't really focused on this at the time didn't notice this, but Moody's
always after the house burned down.
Yes. I mean, I'm sorry to say this. I don't usually like to use this kind of language on podcasts, but Moody's shit the bed.
Exactly.
In 2008, it missed all of it, right? And then after the fact, it came out and it, like, you know, lowered the ratings on everything. And here, once again, it completely missed SVB and all the other banks that now, after SVB collapses, like, oh my God, we better do something. You know, we got to cover our asses. And they went out and they lowered ratings on a lot of other banks, right? But that has the effect too of then amping up the panic, right? And so, I mean,
First Republic was downgraded to junk.
Yeah,
they're going to get bought. They have to.
Yeah, I mean, frankly, really counterproductive in a way. Like, I mean, if Moody's didn't see it before, they should just leave well enough alone, not say anything, right?
Just take it off.
You know,
we missed that one.
Yeah, and just, you know, like, and just maybe go quietly to the FDIC or whoever and say, hey, you know,
we need a little help over here.
This is what we're seeing, right? We just want to let you know, as if nobody else could see it, right? But it just adds to more fuel to that panic fire and not very helpful at all.
So let's flip the coin over. So again, lots of fear. Banks are going to lend less. Regional banks are going to lend less. There's going to be just a lot less loans, and the ones that are done will be more strict, higher rates, bigger, lower LTVs. It's going to be harder for investors. But on the other side of that is where I want to focus. And again, I want to focus there because Olivia and I are coming to your event at the end of April, because we want to learn this stuff and be prepared. I've been very clear with my audience for 4 years. There are 2 things I don't do, but I have interest. One of them is bigger syndications, or bigger deals, whether I take them down myself, whether I'm an LP with somebody I trust or whatnot. So we're going to come to this event in late April. And why don't we talk about the discount first, and then we'll talk about what people, what can people do with what's coming.
Yeah. Oh, so about the conference, and look, we had a really great response from the One Rental at a Time audience. I was really excited to see, and I was frankly really pleasantly surprised by how many people have signed up to come. Nice. So today, this is Thursday, March 16th.
Yep.
Through the end of tonight, Pacific time, so midnight Pacific time, this ends, you can still get a 50% discount off your ticket to this event. And that 50% discount applies not only to your general admission ticket, but to the VIP access as well. So even though I think the price went up the other day by $100, you can get $50 of that back today if you use this discount code that ends today. And it's still a great deal. So be sure to sign up, because, you know, I'm going to be there. Michael's going to be there. We've got a growing crowd of ORAT folks who are going to be there. And it's just going to be a lot of fun. So don't miss that opportunity to get that discount code. And I'll just slip one other thing in here. If you're on the West Coast or you're near Las Vegas, we're probably not going to do this conference in Las Vegas again. So if sort of distance is an issue for you, like, sign up now this year, because if we do this conference again, it's most likely going to be in New York next year. So
my daughter is. I'll come to that. No problem.
Yeah, that's awesome. Yeah, no, I know a lot of people will come to New York too, but I mean, there's some people who like to stay close to home. So if that's your thing, then, you know, please sign up. But the discount code is ORAT50. So you go to multifamilywealthproject.com, and when you go to the checkout page, put in the ORAT50, that's ORAAT 50, to get your 50% discount off this great conference. And as I said, it's through midnight tonight Pacific time. So, you know, time's a wasting.
And just so you know, folks, that was the same discount I was given. I'm not taking a commission, a fee, or any of that. That's not what I do on this channel. It was important for me, for Jonathan, to offer you the same discount I got. And just in case you're watching this anytime after Thursday, you can just use ORAT 30 and you'll get 30% off. But back to why people need to go this, because Jonathan, all this pain, this lending, real estate transactions will still happen. Right now, we're still frozen, but eventually sellers will figure it out, and or banks will take over, and there will be deals to be made. I have been here before, and we did deals up to 20 units. I'm coming to this event because, frankly, I want to do 50, 80 units, and that's what I'm coming to learn. So what do you see as a possibility on the other side of this fear and lack of lending?
Well, listen, I mean, there's going to be great opportunity. There's going to be opportunity that we haven't seen for 15 years, in my view. And the reason for that is simply, it's the same reason as what happened in the great financial crisis. Maybe not to the same devastating effect, but nevertheless, we're not going to, this is the first time we've seen this for a while, and it'll be the last time we see it for a while here to come. And that is that, just as in the great financial crisis, we got into a frenzy. People decided that real estate can't lose. That led them to take too much risk. And then when the market situation that they insisted was going to continue forever, right? If you remember back to the GFC, houses were going to keep going up in price forever. Well, this time around, apartment buildings were going to keep going up in price forever. Interest rates were never going to come down. And as soon as the market starts believing that, they start doing risky things. And then anything that comes along to upset the apple cart has a devastating effect on the people who got in too late. And those, you know, who have no cushion, right? And those people are going to get forced into selling or foreclosed on. And that is going to create a situation in which there are bargains for you and me to buy. And it'll happen at every level, right? So don't think this is going to only happen for, like, you know,
this is not just office building San Francisco. This is up and down the stack.
Yes. This is not just for $25, $30 million apartment complexes that, like, you can't buy. This is going to be, you know, the quads, the 10plexes, the things that's within your range to buy, or you and a couple of partners, right? It's going to be a great opportunity for those LPs who are savvy and don't, you know, get scared by what the media is saying, or don't get scared by, like, their brother-in-law who's like, oh, I wouldn't invest in real estate right now. The market just crashed. You know, the people who understand that when the market just crashed, that's the best time to buy.
That's the time to get in.
This is the time to get in, right? So there's going to be great opportunity, but you're going to have to be a little smarter, and you know, to do it. And here's the way it's going to work now. And I'll give you an example of, like, a deal I'm working on right now, which I think is a perfect deal for this environment. Now, the lenders will get scared and they'll kind of pull back, but they'll also realize that, well, if they're not lending, they're not making any money, right? They're making zero money if they're not lending. So they have an incentive to start finding deals to lend on. Now, they're going to be harder than normal. The terms are not going to be as good as they were. They're going to be, like, really fly specking everything. But if you have a good story to tell, then they're going to be very interested. And if you have a track record, or you can partner with people who have track records, they're going to be very interested, because even though you and I, Michael, you and I and the people who are listening understand that there's less risk after a crash, because the risk is the crash, right?
Exactly.
If the crash has happened, there's less risk, right? But that's not how human psychology works. There's something called recency bias. So after a crash that's really strong in people's minds, they're worried about another crash, even though crashes don't follow crashes, right? You might be in the doldrums for a while, but you don't have like a crash and then like another crash. It can't happen, right?
Yeah.
So the lenders are like everybody else. They're scared, but they need to lend, and so they're going to be looking for stories. And so, like, for instance, I'm working on a hotel deal right now, which has a fantastic story. We're able to get this asset way under value, assuming we get under contract, because of the particular situation that the asset finds itself. It's not being marketed correctly. It's being run kind of as a part-time lifestyle business, right? So if you look at the actual financials, it doesn't look that great, right? But my partners understand that if we implement modern systems, if we implement technology, if we implement proper marketing, and we upgrade the asset, this is another big thing. The asset is kind of stuck in the 1990s, so it can't get premium rates, right? If we address all those issues, we will have a smoking deal in our hands. And we can tell that story to a banker, and a banker is going to respond to that, right? So, and we can also say to a banker, hey, look, at the price, the worst case scenario here is another COVID. If we run this asset at COVID numbers, we still can pay our debt service by a comfortable margin, right? And so that's like the worst case scenario. Another COVID, everything gets shut down for 6 months. We can still pay our debt service under those circumstances. So, Mr. Banker, this is one of those deals that you just can't say no to, right?
Yeah.
And so that there are going to be deals like that out there, right? There are going to be deals out there where people like don't run what they've got well enough, right? Mm-hmm. Or they don't realize what they've got, or they've just been sort of, there's a whole class of real estate owners who are essentially lifestylers, right? They want it to be easy. They don't maximize the rents in their apartments or their hotels or whatever, because they don't have to. They're making a good living.
They're good. Yeah.
Yeah. They're making a good living the way that they're running things, and it's easy. And that's what they want. Right.
Yep.
But you and I can take opportunities like that and maximize the value. So that's what bankers are going to be looking to see.
Yeah. And these are the things we're going to look at the event. Again, myself and Olivia, it's so important for us to look at what we're doing in the next couple of decades of our investing career. She is coming. So the ORAT fans that go there, we will likely, now that we have at least 7 of you coming, Jonathan and I will work on who you are, and we will find a way to get connected and do a coffee or something so we can say hi to everyone. Jonathan, thank you so much. We have 2 more topics to cover.
Absolutely.
All right.